Indranil Sengupta. Indranil, hi, morning, good to have you on the show. How is it that you see agriculture, industry, services, all the segments to perform when it comes to the next financial year?
Well, this financial year we are looking at a growth of 6.8%, and in this particular quarter we are looking at a growth of around 6%. Going forward, I think this pain will last for another 1 to 2 year quarters, and then we could see a turnaround in the second half of the year. So we're looking at about 7% growth next year. There are really three factors at work. The first is the base effect, which will go away by June. The second is the RBI's liquidity crunch, which took place in 2018. So in a sense, the genesis of what you see today was the liquidity crunch of 2018. But after Governor Das has taken over, the RBI has been injecting liquidity. So the impact of that should show up in the September quarter in the turnaround. The third is, of course, the US-China trade war. And, our base case expectation is that maybe it gets resolved in the second half of the year, and that also scales back global uncertainty. So bottom line, I will say that, this is the darkest before the dawn.
Then, but tell me, which segments, according to you, are going to drive growth when you do see a recovery come in? Will it be the one in the slump, that's consumption, or do you think it's going to be a very investment-led recovery that we'll see?
No, it's obviously going to be consumption. First you need rate cuts that will support consumption, that will lead to exhaustion of capacity, and then you will see capex. So right now, given that there's a lot of slack in the economy, it's obviously going to be consumption.
On that point, Indranil, I was speaking with other experts as well. You've got the 6th June MPC policy coming up, and all expectation is that there is going to be a rate cut. But how much can that rate cut really help the economy at just this juncture and really give a leg up to consumption? Because the rate transmission hasn't happened in the last two policies where we did see the rate cut come in. So do you think the need of the hour for the RBI is to actually address liquidity in the system as opposed to just bringing down rates?
Of course, we are looking at a 35 basis point rate cut on June 6th. The RBI has already begun to put in about $2 to $3 billion of durable liquidity every month. I think, the transmission got delayed by the fact that we had elections, which led to high cash demand. But, as you go forward into the next month, we should see, the money market getting into surplus reverse repo mode, barring the advance tax payments, and that should help transmission. So you need rate cuts and you need the money market in surplus reverse repo mode for transmission.
Yields are down as well, more than 35 basis points in 2 weeks. Indranil, banks haven't been able to pass on the recent rate cut either. So, in such a scenario, do you see a lower cost of funds for corporates? And also going ahead, what would be your outlook on the yield and the rupee?
Well, let me put it this way, that, assuming that the RBI provides durable liquidity of $2 to $3 billion a month, which is what they are doing, and, we see another 50 basis points of rate cuts, we should see lending rates coming down by about 50 basis points by the end of the year. The rupee we see roughly around the same current levels through the year, around 70.
Okay. What are some of your expectations from the government in terms of, moves to revive investment, the kind of, financial sector reforms that you're hoping to see? We're waiting to hear on the posts in the new cabinet as well. So you must have a wish list.
Well, We think that, you know, at the BJP manifesto has spoken of, you know, boosting investment by reducing the cost of capital. And it has been our long-standing call that, you know, the RBI needed to cut rates, needed to provide liquidity, to reduce lending rates. So we see that happening. The other thing is that we will probably get anything between 1 trillion to 3 trillion rupees of excess RBI capital from the Jalan Committee, and that can be used to recapitalize public sector banks and bring down you know, lending rates further. I'm sure that the government will take other steps to support investment, but till you have the cost of capital lower, it's very difficult for those steps to fructify, as we saw, you know, for the last few years. So we think that, you know, the first effort of the government will be to intensify you know, policy initiatives to reduce the cost of capital.
Okay, and share with us, you know, your outlook on trade as well, given the current scenario, the fact that not only are we seeing trade tensions, but also a slower growth environment globally all over. You know, where do you see India really landing up on the back of that?
Well, we think that you know, our current account deficit will be around, you know, 2.4% of GDP. Even with $22 billion of portfolio inflows, the RBI will hardly be able to buy $15 billion. So we think that, you know, the global environment will remain uncertain for now, which is not the best of news for trade. But that said, we do think that a lot depends on, you know, what happens with the US-China trade war and how long that persists.
What about on the flows front in terms of FI, FDI investments?
So we are looking at about, I think all in all, about close to $60 billion from FDI and FII. We are looking at about $22 billion of FPI investment into the economy.
Joining us today, Indranil, and sharing with us your expectations there.